Okay, welcome to the Pinnacle Investment Management session where we'll discuss portfolio allocations and the role of global listed property and global smaller companies in your investment portfolio. My name is Mark Cormack. I'm a director with Pinnacle Investment, but more importantly today, I'm going to be your host for our session. We've got a great session for you today. We're really going to go under the bonnet of two essential parts of your global equity allocation in regards to global REITs and global small caps. It's especially important considering the context that global equities has really outperformed mainly in large caps. We certainly know it's been dominated by the Magnificent Seven. We want to really challenge your thinking today and outline some of the most compelling insights that our fund managers are finding in the REIT space and the global small cap space so that you can position your portfolios better for 2024 and beyond. So let's start by looking at global property because it's an asset class that's had the most mud thrown at it in the last couple of years. But it's important to remember that real estate really houses the world economy. Sure, global REIT prices have declined, but they're now trading at significant discounts to direct property. And investing in a portfolio of global REITs provides you with access to innovative and unique sectors that are not available in A-REITs. And importantly, global property also provides you with more income than you get out of a global equity portfolio. Today, we're going to distill fact from fiction and discuss what's really happening in REITs. We'll take you through some of the real estate fundamental drivers such as occupancy, supply, balance sheets, the importance of where rates are and replacement costs and valuations. So without further ado, I'll hand you over to Julian Campbell-Wood, Resolution Capital's Global REIT Portfolio Manager, to take you through why REITs should play a role in your portfolios going forward.
Thanks, Mark. Good afternoon, everyone. So to start off the presentation, just give you a quick snapshot of Resolution Capital so you understand a bit about the firm. We manage $12.5 billion, largely in global REITs, and that's a strategy we've been managing on a consistent basis since 2006, and we've been managing A-REIT securities for over 25 years. So one of the longest track records in the Australian market of managing REIT securities. And the global strategy is what we're here to discuss today. But firstly, why global REITs? Why should you consider it as part of the allocation in your portfolio? Firstly, I'll touch on the fundamentals of the global REIT sector, the attractions of global REITs, and then the opportunity as we see it today, given the market dynamics and the drawdowns, which Mark has touched on. But firstly, what do REITs give you as an investment? They're giving you access to really high quality commercial real estate in major markets around the world in a liquid and unitized form. It's real estate which is very difficult to get access to for private or unlisted investors in this quality and the quality of the operating platforms. And also it's the type of real estate you can get exposure to. Diverse range of different property sectors ranging from healthcare, data centers, cell towers, life science and lab space, self-storage, through to some of the more traditional sectors of grocery-anchored shopping centers and industrial and logistics. Importantly, you're getting this exposure in a liquid form. So in the last couple of years, with the restrictions that some private funds have had, investors have struggled to access their capital. The REITs give you liquidity. Yes, you need to deal with the inevitable ups and downs of a listed investment, but you can access your capital. Now that the sector has adjusted to the significant increase in interest rates, it's better positioned to deliver that inflation hedge, and that's the growing cash flows, which are driven by increase in rents and the growth in replacement costs driving that return and total return. You're getting diversification from the Australian economy. So the Resolution portfolio, over 95% of it is invested in offshore markets, and that ranges from the US, the UK, Europe, through to Asia, including Hong Kong and Japan. Diversification by property sectors, which I touched on, and a critical point which Mark highlighted in the outset, is the capital structures. And this is a true competitive advantage for the listed sector at this point in time, being that they have low leverage. So 30% loan to value across the ResCap portfolio. And that's on values which on average have already declined 10 to 20%. That puts it in a competitive advantage versus the private markets, which may be more reliant on the banking system and are running high leverage. So they're in a good position to take advantage of opportunities. And lastly, and critically, attractive relative valuation versus the underlying property values versus replacement cost, the intrinsic value, the bricks and mortar of the real estate. And over the longer term, they've delivered competitive returns to equities. Now, clearly they haven't over the last 3 to 5 years, but that is also the opportunity as we see it today. So Mark highlighted relevant real estate. What do we mean by that? And this gives you a snapshot of 3/4 of the Resolution portfolio, ranging from non-discretionary shopping centres, residential real estate, or rental, benefiting from the undersupply and affordability issues in many housing markets like the US, Canada, and Germany, through to data centres, benefiting from the digitisation of the economy and the significant growth in AI, through to logistics and segments like healthcare real estate. So a diverse range of relevant real estate, minimal exposure to office property. There's a lot of questions around office real estate, particularly in North America. It's 2.5% of the global REIT index and much less than that in the ResCap portfolio. So it's just not that meaningful in terms of those dynamics which we're seeing in the core of our portfolios. How the fundamentals of the sector, and this is critical to the total returns. And yes, you've seen a drawdown in terms of values as the sector's adjusted to those higher rates. But importantly, the demand and supply dynamics for the vast majority of property sectors are in pretty good shape. And that's high occupancy and moderate levels of supply. Importantly, we're already seeing new development starts decline fairly substantially, particularly for those areas where you did see a pickup in supply through the COVID period. And that was things like US logistics and Sunbelt multifamily. New starts in those segments are already down over 50%. And that helps to underpin the returns for those sectors as that supply is digested. But by and large, it's not been a real estate cycle which has been characterised by excessive construction. And this is probably one of the most important charts and dynamics in terms of real estate invested and listed real estate at this point in time. And that's been the significant increase we've seen in replacement costs, which have increased 30 to 40% over the last 4 to 5 years. So a significant increase in physical construction costs, and this we're showing you in terms of the US. And that means the threshold for new development, the economic rents needed to justify new development are that much higher. And we're already seeing the economic impact of this, slowing the new development starts, and that will underpin the returns for the sector over the next 3 to 5 years while these dynamics persist. What does that mean for value? You hear a lot about intrinsic value, and for real estate, there's really replacement cost, as we touched on. So the bricks and mortar value of the real estate. And we're at an interesting point here in real estate markets where replacement costs are up 30 to 40%, property values have declined 10 to 20%, and the rents haven't risen to a commensurate amount to make that development economic. So when we look at a simple model of real estate where land is about 30% of total value, you're really not paying anything on average for the land, given those dynamics of high construction costs and a reduction in property values. So we think this helps to underpin the value of the sector in that it's trading around those physical replacement costs. And that will really help to underpin the returns for the sector. When we look at the recent performance experience and valuation at different limelight, clearly the sector's had an unusual period. So over the last 30 years, to have 2 drawdowns of the quantum we've seen has been historically unusual. So the sector is at least 25% off its highs. It is now adjusted to the post-QE and higher interest rate environment, and we think it's absorbed that impact fairly well. It's trading at a discount to the underlying private market values. So this is the long-term price to net asset value for the global sector. And importantly, that's on net asset values, which again are down, with values down 10 to 20, net asset values down even more. So undemandingly valued versus net asset value on values that have already adjusted lower. And you're seeing this being reflected in some of the privatisation activity already this year. So Blackstone has privatised 2 public REITs in the residential sector in the US, reflecting what they see as good value, the REITs being cheap to the underlying real estate and the forward returns of the real estate. So the REITs are undemanding. Now, we've included the chart versus global equities. As real estate investors, we focus very much more on the real estate value, but it is undemanding versus global equities since the inception of the strategy. Now, to give you a flavour of one of the larger investments in the portfolio, this is one that some of you will be familiar with, given it is The residual part of the Westfield portfolio, Unibuy Rodamco Westfield, they bought Westfield in 2018, did so with too much debt, which has caused a challenging period for the company in which we weren't invested because of the capital structure issues. But they've now taken the company to a point where they've continued to deleverage. They've now been in a position to reinstate a dividend while still very low payout ratio of 26%. It's a 3.5% yield with significant capacity to grow. The portfolio is performing exceptionally well. So metrics are back better than pre-COVID levels. Incomes continue to grow across the portfolio. Demand is solid, and the portfolio is still significantly discounted versus its historic level. Unibuy Rodamco used to be the benchmark REIT in Europe in terms of capital management and operational performance. And we think it is closer to being back to its former self as it continues to deleverage and focus on the operational performance of the asset. So even after significant returns since we initiated this position, we still think there's opportunity in a name like Unibuy Rodamco Westfield. And bringing that together, the REITs to us are offering access to some of the world's best real estate and operating platforms in a discounted valuation environment. They've adjusted to the higher interest rates and post-QE world, and they have excellent access to capital, and that'll put them in a competitive advantage versus many in the private markets, given low leverage, limited refinance. So some of the headlines you see around massive refinance headwinds, this is not the case in the listed market. That puts them in a position to take advantage of opportunities. Development, the math on average is difficult, uneconomic in many cases for new construction, and that will moderate the supply outlook and underpin rents for existing landlords as we look out over the years ahead. Operations are solid, so occupancy is high, supply is moderate and declining. We think the sector is priced pretty attractive levels on a relative basis and close to the intrinsic value of the bricks and mortar of the real estate. So with that, I'll pause there and hand it back to Mark.
Well, thanks, Julian. That's a great comprehensive overview on the global property market. Just a reminder for all attendees, they can ask questions on the questions tab on your screen there. We will be doing questions at the end of our session, so place any questions in there regarding Resolution Capital and global property. Our second speaker today, we're going to look at global small caps, and I'm delighted to introduce Greg Dean, who's the founder and lead investor at Langdon, who are a specialist global smaller companies fund manager based in Canada. Now, whilst Langdon may be a new global equity small companies fund manager here in Australia, Greg has a long and outstanding track record of successfully managing global small caps from his time at Cambridge Investors. Since inception, the Langdon Global Smaller Companies Fund has outperformed the index by 7% per annum. Now, in brief, how does Greg and the Langdon team manage that portfolio? Well, they have a high conviction approach. They have a focus on cash flow and businesses that can compound their earnings, and ideally these businesses will have low or no debt. The portfolio style is defined as quality, growth at a reasonable price. So with valuations compelling, there's a great opportunity to deliver some outstanding returns in your portfolio when you're looking at global small caps. Enough from me. Let's hand over to Greg Dean, the founder and lead investor at Langdon, to take you through global small caps.
Thanks, MC. And thanks, everyone. It's our first Morningstar Investment Conference. Appreciate the time. I wanted to start actually with a bit of what we won't do. So two things I can promise today. We actually probably won't pitch you on the timing of this asset class, global smalls. And two, our goal, our career-long goal is to never have to make predictions when investing. We prefer to make observations. So my sense would be that you've probably never heard from a portfolio manager who didn't think their asset class was attractive at the current moment. So one important reason for why Langdon and why build a business in global smalls is actually has a lot more to do with the size of the asset class and the inefficiency, which we believe to be structural versus anything related to timing. So for us, our North Star is cash flow. We think it's the only sensible North Star for an investor to both evaluate the quality of a business, but also determine what price to pay for a business. So we focus on cash generative smaller companies. The average age of a business in our portfolio today would be close to 40 years old. So it gives you a real sense for, the maturity profile and the experience and track record of the companies we invest with. We scour the world for, let's call it 5,500 different companies we could own. We typically own 30 to 35. And we think that's why we're able to deliver the returns that we have. Mark quoted sort of the Langdon track record. The broader investment approach track record going back to my prior firm is about a 15% net return over the last 13 years, which would have been through bull markets for small caps, bear markets for small caps. And even over the last 10 years, I think the Russell did about 8%, and we did closer to 15 net. So substantially above, let's call it the benchmark. How did we do that? For us, the biggest thing is we focus on and companies, not or companies. The current environment penalizes or companies because if you, deployed capital when, the cost of capital was extremely low, you probably are having some issues today. Perhaps you've got leverage issues or counterparty risk, or you're in the midst of a large restructuring program because you were hiring at an aggressive rate and now you're, letting people go. And companies are more likely to have superior outcomes, we believe, because there's just more optionality embedded in those businesses. So they're able to do well under different economic scenarios. The most common example we're finding today, companies that are able to make acquisitions and buy back their shares, or companies that are able to invest for future growth and pay a dividend. And one of the core philosophies at Langdon also is just that we believe the return you're entitled to as a long-term investor is the underlying rate of compounding of the business. So one thing, again, that we don't do is underwrite multiple expansion. We think we call that the greater fool theory to investing. A lot of people do it, but and it has worked very successfully for people for long periods of time. But to us, if we're going to invest in a business today, we have to believe very strongly that we could exit that business in 5 years or 10 years at a multiple significantly lower than the multiple we're entering and still deliver at that 15% hurdle rate. If not, there's probably a better investment opportunity out there for us. And so who is doing this work? The team is myself as well as 4 others, and we're oriented regionally. So today I'm in Bermuda at a reinsurance trade show and meeting a number of large reinsurers and specialty underwriters. And, Alex is in Japan, Isaac is in New York, Joel is in Mansour in Toronto. So we're very infrequently all together in the office. Most of the job is actually spent out in the field, collecting information, building relationships, talking to companies, talking to industry experts, just building our mosaic around the businesses and the industries we invest. And to help people understand kind of where we spend our time, we actually now share this information with all our clients on our website. But this is, an overview of, call it, the last 18 months, almost 500 company meetings almost 500 different companies met, closer to 800 meetings in 60 cities and 16 countries. So think of it like we meet the S&P 500 every year. And that's, again, why we're able to say we don't really care if the asset class is attractive or unattractive. It's our job to find a great opportunity set that can decouple from the broader asset class over a reasonable period of time. And so, we focus on high quality, smaller companies, and we work quite collaboratively as a group. So we have at least 2 investors tracking down every single idea in the portfolio, which helps eliminate a lot of bias that you'll typically get when you have a high conviction portfolio and it's sort of somebody's ego or somebody's emotions on the line when you're making those investment decisions. And I think this is just something that we're sharing more and more because it's becoming worse and worse. So not only is there significantly less people hunting for great companies within the small cap universe, people forget that the small cap universe actually represents 90% of the publicly traded companies globally. So it's about 10% of the market cap, but it's 90% of the companies. And on average, there's about a quarter of the amount of coverage of a larger business. So there's less people focusing on more businesses, and that's been super attractive. So we can get to this in Q&A, but we put together, what we fight as small cap investors is unfamiliar. People think familiar is safe and unfamiliar is risky. So we actually go into a lot of detail in the business to describe the companies we own. A private equity firm based in New York, a multi-beverage manufacturer based in Fax, Denmark, a litigation funder based in New York and London, the largest hotel chain in Ireland, as well as a personal lines broker based in Westlake, Texas. These are not household names. You're not paying bills with these logos on them, so we understand how unfamiliar they are. But in our view, that doesn't make them more risky. We'll speak to the case study perhaps in Q&A. But just to keep us on time, it has been a great start in what I would call not a great environment for small cap. That is sort of our calling card, as we try to do our best work when the asset class is most dislocated. We think that's how you create long-term enduring value for your clients. And this outlook has probably been what we've believed for close to 2 years. We don't care if interest rates are 0.5% or 5%. And we think the best defense against uncertainty is value-creating companies run by talented teams who think and act long-term. So very pleased with the early start of Langdon. And we think now now is as good a time as any to be looking at global smalls.
Fantastic, Greg. And Greg, from memory, I think back in North America, you were Morningstar's, was it fund manager to watch back about 8 years ago?
Yes. I had a lot less gray hair back
then. Okay, so let's kick off the Q&A. We might start with Resolution Capital and Global REITs. Julian, do you and the Resolution Capital team avoid certain parts of the global REIT market?
At certain times, we will not invest in certain parts of the market when the fundamentals don't warrant investors' capital. And there's examples of that more recently have been in office markets. The history of the strategy, we've had upwards of 30% of the portfolio in office in years pre-COVID. We cut a lot of that at the start of COVID. And we really haven't seen the fundamentals in the US market, particularly Australia, warrant further investment. But we have found office markets around the world where fundamentals are good. So Tokyo, for example, vacancy rates are mid-single digits, and they've been some of the best performing positions in the portfolio in the last 12 months. West End of London, similar dynamics. So the benefit of being global is, yes, you're right, there's pockets of the market at any point in time which we'll find unappealing due to this demand and supply balance and risk profile. But there's always areas that we can identify, even in sectors which may be perceived to be particularly challenged in other markets which have different dynamics.
Look, Greg, you mentioned a little bit about how you invest. Why don't you screen on growth or valuation?
Yeah, great question. I'm a mathematician by trade. So, one would think that we have this, supercomputer of a quant screen, given we've got 5,500 different companies and we're only looking to invest in, a couple dozen. But the reality is, having done this for a number of years, we realized that, a quant screen can help you find obvious quality or obvious opportunity. But if you want to impose a massive factor tilt into the top of the funnel, then just screen on PEs and ROEs and growth rates, and you can build a nice tidy universe. But the reality is, the best opportunities often don't screen great. A great company with a great long-term track record that's undergone some sort of short-term issue that's triggered revenue growth to slow or returns on capital to decline, that's the moment you want to be hunting down that opportunity and making an investment. So we decided to do something, I guess, crazy back in 2016, is we just said, let's meet every single company in our universe every 5 years. And that way we're not going to miss anything. And if we do, it's our fault, as opposed to saying it's Bloomberg's fault or it's Capital IQ's fault or it's FactSet's fault. So it does require us to take the number of meetings that we do, but it helps us improve our return on time and understand why we're looking at what we're looking at.
Okay. Back to you, Julian. Look, with interest rates rising, how does rising replacement costs really impact your thinking?
It's a good question, Mark. It's something we've been highlighting more for clients as really helping to underpin the value of real estate. And the sector, not just the listed sector, but real estate broadly has had to adjust to the significant step change in interest rates. And a lot of that has largely been washed through. So depending on the markets, on average, you're seeing declines of 10 to 20%. And in certain segments, significantly more than that, where you've got operational challenges. But the significant increase in cost to deliver new buildings, coupled with the fact that values have adjusted downwards, the economic rents and the development math is very difficult for certain property sectors. And it's not all that case. So clearly data centers is one where the math still works and there's a ton of capital. But when you look at other things like residential, multifamily, seniors housing, retail, office, clearly, there the development equation is very difficult because of that replacement cost increase. And when you look at the value of a building between physical construction costs and land, etc., when you make those adjustments, you're not paying a lot for the land, if anything, at the moment. And that, to us, helps to really provide a good value benchmark for the sector at this point in time.
Okay, Greg, back to you. Look, how are you finding growing businesses trading it below their net cash?
Yeah, well, I thought, we learned in the 1980s that wasn't supposed to happen anymore because the market was efficient. So in the 40s, people were finding these nets, and then it became cigar butt investing, because the only way you'd find a business trading below net tangible assets is because it's broken. And here we are, even a couple of years ago, 10 times sales was cheap. And our largest holding as a firm now trades below the net tangible cash on its balance sheet. So it is an awesome time, we think, to be hunting down these opportunities. There's a lot of dislocations between price and value in the stock market, but I think it's because we're not screening. Like Westaim would not screen attractive today. It's a holding company that has 7 employees, and roughly revenues offset costs at the holding company level. But their investment in a specialty underwriter that went public last year and is up 140%, and the private credit manager that they seeded in 2015, probably two of the hottest areas in financial services, both have been growing 15% for 8 years. It just doesn't show up in the consolidated accounting maths. And so it's missed by a lot of investors. And so it trades below the cash on its balance sheet, and we get the entire operating businesses for free. And we think that's super interesting. And it's not the only example we have, in our portfolios today, but it's probably the most dislocated example.
Okay, talking valuations and just going back to G-REITs, how does the current drawdown in G-REITs compare to the GFC? And just remind us of how G-REITs performed coming out of the GFC. Feels like we're at such a kind of point, Julian.
Yeah, the GFC was a much more severe environment given what was happening in capital markets, and that was reflected in the drawdowns in REITs. So the chart I showed earlier, you've seen roughly 20 to 25% declines in terms of peak to trough of drawdowns during the COVID and the rate resets. Depending on the market, you were looking at upwards of 50 plus for REITs during the GFC, given the dislocation there. The difference here is it's just been about, for many property sectors, just adjusting to the increase in discount rates. Because across the vast majority, with the exception of pockets like US office, etc., rents and cash flows have still been growing. So that sort of 10 to 20% average value decline has really been about high discount rates, because operating conditions continue to be pretty solid and rents and cash flows continue to grow. And that's helped real estate and listed REITs absorb some of that adjustment in discount rates.
Okay, last question over to you, Greg. Look, how does global small cap returns and volatility compare to emerging markets historically?
Yeah, it's so interesting. There's sort of the global equity bucket for most investors. And then, I find global smalls isn't yet fully independent from global equity. So when risk appetite is low, I think it just gets swallowed back into global equity and people are sort of focused on large. But then when you get in these more confident environments where people are feeling a little bit or willing to take a little more risk, it's always global smalls paired off against EM, and there's only room for one. And my observation, and we used to invest in emerging markets, is that, call it 1 in every 5 years, there's something outside of your control that usurps the opportunity that's supposed to exist. So whether it's geopolitical, whether it's interest rate or currency, there's just something where it makes, whether it's China, Brazil, India, it's just not the opportunity that you thought it was. So in our view, you're taking a significantly lower amount of risk to earn what ends up being a superior return over reasonable periods of time in global smalls. And the same argument would go for private markets. 15% net returns is about as good as it gets in private market investing as well. And that's with leverage and multi-year lockups. So we find it interesting that global smalls is sort of the the overlooked obvious opportunity, but my sense is that won't be forever.
Fantastic. Look, thanks so much, Greg, Julian. Really appreciate your time. Look, with global equities really outperforming and dominated by US large caps, especially the Magnificent Seven, hopefully we've shown you today that there are opportunities with Resolution Capital in global property and Langdon in global small caps. So thanks so much for your time and have a great rest of the Morningstar conference.